Most investors don't lose money because they picked one terrible stock. They lose it because they fill their portfolio with assets that look rich, sound smart, and still fail the one test serious money cares about. Does this thing actually produce anything? That mistake feels harmless at first because the trap often looks modern, exclusive, or exciting. But over time, it drains returns while real businesses keep compounding in plain sight. In this video, we're going through 5 popular assets that fail the billionaire filter, and we'll compare them to the kinds of productive companies you already find inside the S&P 500. If you are serious about long-term growth, hit subscribe now, because once you see this filter, a lot of investments stop looking like investments at all. So before we get to the 5 traps, we need a clear filter. Serious investors don't start with buzz. They start with a few plain questions. Does the asset own something useful? Does it produce cash flow? Can it scale? What friction sits between you and your return? And if the story gets quiet for a year, is there still a business underneath holding it up? That last part matters more than people think. A real asset can survive without attention because the business keeps selling, billing, shipping, drilling, building, or collecting. A fake asset usually needs a fresh wave of belief. Once the excitement fades, the weakness shows up fast. Why do these traps spread so well? Because they sell a shortcut. They sell speed, status, and the feeling that you found the back door to wealth. Slow compounding feels dull, and a lot of people would rather buy a great story than a steady machine. But elite investors don't pay for entertainment in the wealth bucket. They pay for output. Let's start with speculative crypto that has no clear productive use. I'm not talking about the whole space as one block. I'm talking about coins and tokens where the investment case rests almost fully on someone else paying more later. If the asset doesn't generate earnings, doesn't give you a claim on cash flow, and doesn't tie to a business with durable demand, then your outcome depends mostly on price mood. That's not a plan. That's a crowd auction. Now compare that with profitable businesses inside the S&P 500. Some sell chips. Some run software systems. Some move energy, goods, or payments. You can argue about price, and you should, but at least you're starting with a real engine. The company does work. It earns money. It can reinvest. That gives you something solid to track besides social media heat. Now let's pivot to high-fee funds and packaged products. This trap looks safer because it comes wrapped in professional language, but cost still matters. And a small annual fee can keep shaving your return year after year, while the manager may or may not give you anything extra in exchange. People often confuse complexity with skill. They assume that if the product sounds advanced, then the return must be better. Most of the time, the fee is the return story. That's the problem. If your fund needs a long explanation, you need to ask a short question. After cost, what do I actually own? In many cases, low-cost exposure to strong, large businesses gives you a cleaner path. The less friction you carry, the more of the compounding you keep. The third trap is luxury real estate bought for image instead of yield. People hear real estate and assume safety, but a hard asset is not always a good investment. If the property sits half-empty, carries heavy debt, pulls cash for upkeep, and depends on resale fantasy more than income, then you don't own a wealth machine. You own an expensive bill. In contrast, public companies tied to housing, infrastructure, and services can give you exposure to real-world demand without the same landlord friction. And once you see that difference, the next 2 traps get much easier to spot. The fourth trap is meme stocks and penny stocks. This one pulls people in because the share price looks cheap, the chart looks explosive, and the whole thing feels like a fast lane. But a low price per share tells you almost nothing. A stock at $2 can still be expensive if the business is weak, and a stock at $200 can still be fair if the business keeps producing. What pulls people into this trap is the crowd effect. You see a sudden spike, people post screenshots, and it starts to feel like you're late to easy money. But this is usually timing luck dressed up as strategy. Most viewers are not running a trading desk. You are trying to build durable wealth, and that means you need assets you can study without guessing what a chat room will do next week. Now compare that with established S&P 500 companies. They may move slower, and that's fine, because you can track revenue, margins, debt, market share, and free cash flow instead of just momentum. You are not buying a symbol and hoping it trends. You are buying a business and watching whether the business keeps doing its job. The fifth trap is collectibles sold as investments. This can mean watches, art, rare cards, limited items, all the stuff that comes with a neat story and a sense of status. And look, some collectibles can hold value. That's not the issue. The issue is that resale depends on taste, timing, buyer mood, and a thin market. When you need liquidity, the spread can punish you fast. There is also a problem most people ignore. Collectibles do not produce. They sit there. You may pay for storage, insurance, authentication, and resale fees, while the asset itself does nothing to help your return. That's very different from owning part of a company that keeps selling products, signing contracts, shipping goods, or billing customers while you sleep. So if we put all 5 traps in one frame, the pattern gets clear. They often lack durable cash flow. They carry high friction. They depend on story, mood, or resale conditions more than ongoing output. And they tempt bad behavior because the price action gets louder than the economics. What does serious money usually prefer instead? It tends to move toward productive businesses where demand is easier to understand. Inside the S&P 500, that often means profitable tech firms with real products and strong balance sheets, infrastructure and industrial businesses tied to power, transport, and maintenance, and energy companies linked to physical output and real-world use. The names change. The filter does not. You can also keep this simple. If you want broad business ownership without trying to pick every winner, low-cost index exposure gives you a clean way to own a large group of established companies at once. That is very different from owning a pile of assets that need hype just to stay interesting. Think about this principle. Speculation and wealth building are not the same bucket. If you want to speculate, fine, but keep it separate, keep it small, and do not confuse excitement with asset quality. Every holding in your main portfolio should answer one plain question. What does this own, produce, or earn? That question cuts through almost all the noise. So the shift is simple. Fake assets ask you to trust the story, while real assets let you review the business, and that one difference changes how you build wealth over time. Look at your portfolio today and label each holding as productive, costly, speculative, or unclear. If this helped, subscribe and tell me in the comments which trap you see people buying most often, and which real asset you would choose instead.